and Dasha not that long, but long enough to think super, super highly of them and be excited to partner in 2026 and beyond. They are top tier operators. I've spoken to probably 80 to 100 operators buying all sorts of mobile home parks, multifamily, self-storage, RV parks, and they are one of 3 groups that I've decided to partner with, put my brand next to their brand just because I have so much faith and trust in them and the deals they do and the integrity they have while they do it. Super excited to have Rob here. It's pretty special night. So what a way to wrap up 2025 with Rob Beardsley.
Yeah.
Thank you very much. Okay, cool. Okay. Thanks for that very warm introduction, and I'm honored to be here for your guys' final BAMM event. So super excited to share some fun topics here. I've got some slides presented, and I know this is a pretty sophisticated group. You know, some repeat. Can't hear me in the back?
For the back, thank you.
So yeah, we've got a pretty sophisticated audience tonight, so I'm gonna maybe breeze through some of the more basic introductory stuff, and hopefully we can get to the meat and potatoes that will be very interesting. Before we do so, though, I'll just give myself a little bit further of an introduction and background. I'm the founder of LSCRE. We got our start in 2018, acquiring our first property in Houston, and then from there we never looked back. We've acquired now 25 properties throughout the state of Texas. We have nearly $1 billion in assets under management, like Mike mentioned. And we're also vertically integrated, so that means we have property management and construction management in-house, which adds a completely different layer of the business that I never thought I would be dealing with, like hiring and firing, like toilets and termites, and all the drama of property management, like cars crashing into your tenants' units and so on and so forth. So that's something I'll be talking about towards the end as well, just about the latest and greatest of our operational methodologies and how we create value for our investors through kind of being like a mom and pop landlord, but expanding that on an institutional scale, because at this point we're close to 6,000 units, but we don't want to lose that small business core. You know, we're a family company, and we all treat every dollar and cent going through the properties like it's our own. And it's a little bit obsessive, but you know, $100 here and $100 there really adds up. So before we dive into that segment, I just want to talk about state of the market. Some of you, this might be new and exciting. Some of you, this might be old hat. But I just want to talk about the macro and the micro, because we're always living in the present moment, and the zeitgeist, as I think it was Daniel who was talking about, you know, he's not wrong when he's saying like, hey, a lot of people have been burned with poor performance and capital calls and deals that were overpaid for and over-levered and so on and so forth. So that really has captured the psychology and the headlines. And that is the micro. And there's a different macro story. And there's also a new micro story that's around the corner. So for many of us in the industry, it's been a tough, last 3 years, ever since interest rates went up at the highest rate in history. And we've kind of become allergic to bad news. But good news is coming around the way. So we'll be talking about that too. So let's dive into why multifamily remains a core asset class. So zooming out a little bit, this is a bit of the macro picture in case you guys are brand new to multifamily, don't know why you should be sitting here, why you should be considering investing in multifamily. Here are the fundamentals and the benefits. Super quick, population growth underpins the multifamily investment thesis, and the US has been very fortunate to experience enduring population growth. Texas is no exception, it's actually the leader. And that's where we focus. So in Texas, we've seen 16.1% population growth over the last decade. That's over 2x the national average. Really, you want to be investing where the growth is. It sounds simple, and real estate is simple. It's just hard. Housing shortage. This is another big macro trend, and it's kind of falling on deaf ears recently because we have actually gone through a period of overbuilding, and a lot of markets are oversupplied. But in the macro, the US has a housing shortage of 4 million units. So this is creating a perpetual supply-demand imbalance in favor of owners, in favor of landlords, which means that you can count on rents going up. Not necessarily every month, not necessarily every year, but in the long run. So if you've got a vision for the next 5, 10, 20 years, and you're invested in the right growth markets with the population growth and the shortage fundamentals, you're going to be very happy. There's a couple other things that are exacerbating these two big trends, right? You've got the two big pillars of demand and supply, and then you've got some things that are exacerbating these trends. And so that is lack of affordability. And it's very simple. New developments or developers are building new construction that caters towards the top end of the spectrum. They're building luxury product at the highest rents that the market will absorb. And what that means is that the affordable segment is being left behind from a supply perspective. And a lot of you are probably familiar with this workforce housing thesis, right? They're not building new workforce housing unless it's usually assisted through some sort of tax credit program. You're actually even seeing supply destruction in the workforce housing segment because older properties might be getting torn down and rebuilt, or they might just be getting rehabbed up to a new level. So that affordable space, that sweet spot, wherever it might be for your given market, is a really exciting segment where I think you can see that enduring growth, and you have a little bit of a supply moat. And here in California, we're blessed with a lot of supply moats. We've got water, we've got mountains, we've got politics. It's very hard to build product here, and that's actually good. And not to say that rent control is good. I mean, I don't think that is good for anyone, but in a way, all it does is actually make things more expensive. So it's good for the existing owners. And then finally, the cultural shift. It's not new. It's been happening for a while, and COVID really exacerbated it. But we have in this country delayed family formation. We have change in preference in terms of home ownership versus renting. And essentially, home ownership is getting pushed back later and later. It's becoming less popular from a preference perspective, but also from an affordability perspective, unfortunately, for those who are seeking to live the American dream, which is changing. So this is kind of the macro, this is the 20-year picture, but what does it all mean for investors? So from a benefits perspective, here are the things that multifamily does in terms of taking those fundamentals and turning them into an investment strategy. Number one, first and foremost, is monthly cash flow. It sounds very simple, but it's the lifeblood of our business. And it is also an indicator of health for a prosperous investment. It's also a way to mitigate risk. And I'm not saying deals that don't have cash flow are bad investments, but they are inherently more risky. So we don't invest, for example, in like the middle of nowhere, Iowa at an 8 cap, where there's great cash flow, right? And you could say, oh, well, I'm all about the cash flow. Well, not quite, right? You want to be with a right balance. You want enough cash flow to kind of pay the bills, to have a stable business, but we're not taking it crazy and trying to buy the 8 cap, the 10 cap in a terrible neighborhood, so to speak, because we want appreciation. And so people for the last few years have been saying, well, why would I invest in multifamily at a 5 cap or whatever cap, and the deal only generates a 4%, 5% cash flow when my money market account generates 5% right now or 4%. And as we saw, the Fed just cut rates. That money market account is going lower and lower and lower. And that's kind of the difference, is short-term yields, whether they be risk-free rates, CDs, whatever, bonds, those are here today, gone tomorrow. And it sounds cliche, but you can't value add a bond. And you can't force appreciation on a money market account. So the value in multifamily is the monthly cash flow, coupled with the fact that you have the opportunity to be in these growing supply-constrained markets where you will see enduring rent growth, which correlates directly to value growth. And when you use the appropriate amount of debt, you can see great results over time. The other really powerful thing about the money market delivering you 4 or 5%, yes, it's risk-free, is there's no tax benefits. And so lately, private credit has been a super hot topic. And it's basically alternative investments, not liquid generally, that are in debt rather than equity. So you'd be investing in the debt backed by a company or backed by real estate or like a fix and flip fund where you're not actually the fix and flipper, you're the lender to the fix and flippers, which is a great business model and that generates high yields, 6%, 8%, 10%, 12%, but it's taxed as interest income. So the big difference with equity investing, specifically in real estate, is the government loves you and you get benefits like depreciation. And when you utilize cost segregation studies and you utilize the newly reinstated 100% bonus depreciation, you can really make things hum on a post-tax basis. And that's what we're all about. I'm not about the vanity metrics of how much money we made here and there. We want to know how much are we actually keeping on a post-tax basis. So that is one of the major leg ups on real estate equity investing over almost anything else. And it's lost on people because people are generally comparing investments on a pre-tax basis. They're looking at stock returns, they're looking at real estate returns, and what have you. And in the investment world kind of tends to ignore taxes unless you're super rich. Then you talk to the ultra high net worth advisors, all they talk about is taxes, right? Because it's such a big piece. And this you cannot ignore. And then when you couple depreciation with 1031 exchange, which we have my sister Dasha here who just wrote an amazing book about 1031 exchanges, shout out. When you couple those two powerful tax benefits, that's when things get very exciting because you're able to take advantage of the near-term tax benefits, which is essentially the deferral through depreciation, and you're able to kick that can over and over and over again through the 1031 exchange. I'm sure a lot of you have heard of it, probably many of you have done it. It is something that I think gets us very excited because it is, they say whoever can think the most long-term is the most competitive. They have the highest chance to win. And there's nothing more long-term thinking than 1031 exchange. A flip, that's very short-term. You can make a lot of money today, it's great, but the 1031 exchange is, I'm going to be rich for a very long time and my kids are going to be rich and we're not going to pay any taxes. So that's something that is well known, but I think it's less well known in the syndication space. And it's really such a shame because a lot of these institutional funds that invest hundreds of millions of dollars, we talk with them and they go, yeah, the 1031 exchange doesn't matter. We're a fund, you return cash to us and we go do something else with it. It's a big missed opportunity. And so we pride ourselves on the fact that we are really the industry leaders in 1031 exchanges. We bring in countless 1031 exchanges into our deals. So if we have investors who are, let's say for example, classic scenario would be a tired landlord and they own a rental property and they have maybe $1 million or $2 million of equity in that property. They no longer want to be the sole owner in this rental property. Maybe the value has been maxed out and they want to move on to the next opportunity, but they don't want to sell because they don't want to pay the tax. They don't want to go through the burden of the 1031 exchange and they don't want to find themselves the next project, right? We're able to bring them into our deals where we're raising, let's say, a $20 million on a $40 million purchase. They get to be a part of an institutional property that has a business plan for growth and all while deferring their taxes. So that's something that we really pride ourselves on. This year, actually in October, we closed on a deal where we had a 1031 exchange investor, we had a reverse 1031 exchange investor, and we had a 1033 exchange investor. So you could look up what that is, or you could talk with Dasha and she'll tell you more than you'd like to know. Okay, so just to put a bow on it, I think this picture or this chart is worth 1,000 words. So you could just see, you take any assumptions you want will work, but if you take a $100,000 initial investment, let's say you hold on average 5 years, which is what typically people project for medium-term holds, you project a 15% annual return. That's not an IRR, that's just an annualized return. And then you assume a 35% tax rate, which is perhaps conservative. So maybe the 15% is aggressive, maybe the tax rate's conservative, but you start here, over 30 years, you end up with about $1 million. You sell, you pay the tax, you reinvest. You sell, pay the tax, reinvest. If you were to have 1031 exchanged all along the way, you end up with nearly $3 million, almost 3xing your investment over 30 years, right? The difference is not a big deal until it becomes a big deal. And so this is where I get really frustrated with the online gurus who say, oh, the 1031 exchange, it's the most overrated thing in real estate because once upon a time, someone bought a bad deal because they were in an exchange and they were forced to buy the bad deal. No. This is the power of the 1031 exchange. Okay, so just to zoom in a little bit on the micro, where we are today, because we talked about the big macro, But here's where the micro is. And this is, I think, personally very exciting. So here we were. Things started to get very, very hot and aggressive. And we saw actually record transaction volume in history in the 21, 22 era. And the volume, which means people buying and selling, peaked. And it coincided, as it always does, with price. This is the US national price per unit for multifamily. So, when people are doing the most buying and selling, that's when the values are their highest. And so we saw valuations peak. And then you see not a lot has gotten done since, right? If I'm sure many of you guys in the room are doing less deals than you were back in 21 and maybe 22. And price reflects it. So when it's hardest to invest, that's actually the best time. And so that's what we've been telling ourselves. We've been telling our investors that it's not an easy time, but history shows that when it is hardest to invest, it actually rewards you the most. And I love the quote, when it's time to invest, you won't want to, right? Because we're fighting our own psychology because we're upset about this. This hurts, we're not happy, right? And so we're busy worrying about this and saying, well, it's only gonna get worse, everything's horrible, it's never gonna get better, right when it starts to. So these are just some, these are CoStar charts at a national level. You can just see the classic cycle, here we go, and 2025 is about over, and we're projecting, or CoStar is projecting, an increase in price per unit. So we're not market timers. I'm not telling you today is the time to invest. It's always the time to invest. Even here was the time to invest, believe it or not. Because you don't know. Hindsight's 2020, but here you don't know.
Actually 2022.
2022. Yeah, 100%. So now we are at the bottom. We're close to the bottom. I think we've rebounded off the bottom a little bit. And heading into 2026, it's a very exciting time. And there's less competition, and there's less supply. Supply is coming down. And this is the supply chart. And so this is something that I'm going to be talking about more in a second, which is supply of new apartments. And I briefly touched on it as far as one of the main macros, right? You've got demand, which is basically people, and jobs, right? Because people are great, but if they don't have jobs, they can't pay your rent. So it's really jobs and then supply. And this is a beautiful chart because it just shows how abruptly the supply pipeline is projected to fall off a cliff, right? We've had record building. Basically, money was free, interest rates were zero. Developers would buy land, they could build, so they would get a construction fee. And then now it's projected to totally fall off. And so that bodes very well for the supply-demand picture. Okay, I'm going to go ahead and skip over this. Skip over this. Now I want to talk about we're going to zoom in a little bit more and talk about micro a little bit. And I just want to touch on some of the markets throughout the country because it really hammers this point home about supply and demand and how, in my opinion, supply has been the headline that really drives everything else. If you basically want to find out what's going on in a market, just ask what the supply situation is. That has been the overwhelming factor for fundamentals. So Charlotte, it's a great market. A lot of investors invest here. They want to invest here. It's a desirable market. It's liquid. But when you look at the job growth versus supply story, it paints a very bad picture where we are right now. Oh, sorry, I don't have, I think I might be missing, okay. So I'm missing a little bit of it. I'm missing my favorite chart, but it's okay. So just to cut to the chase, Charlotte's job growth in 2025 was 1.4%, but the construction was 7.1% of existing inventory. That means if the Charlotte market had 100 apartments, 7 were under construction. That is a very big number. You have to have a lot of population growth. You have to have a lot of jobs to keep up with that. You know, as fast as these Sunbelt markets are creating jobs, like a Dallas, like a Charlotte, you know, like Florida, developers can always build more units than the economy can create jobs. So that's the scary thing. And Charlotte's experiencing just that. And so the trouble that I have with a market that's experiencing such dramatic imbalance of supply and demand is you can't buy there. And it's unfortunate to say. And I'm not saying you can't as in like, hey, don't do that. I'm saying you literally can't, because the sellers are all holding on to yesterday's pricing. And the sellers are blind, not literally, but they are unwilling to believe or to come to grips with the fundamentals of the market. So meanwhile, the properties are giving 1 month free concession, 2 months free concession, right? You're talking 20% discounts on rent. You can't underwrite a cap rate. There is no cap rate there, right? These properties are not cash flowing. So it's until the sellers, so one of two things has to happen, or a combination. Sellers have to reprice and they have to get realistic and bring their prices to match fundamentals. Or sellers are going to wait until the fundamentals catch up to their price. Neither is right or wrong. And the reality is this cycle has been different than perhaps the great financial crisis back in 2008. Because in 2008, banks took a different posture. It was a different style of recession. But people are not foreclosing, banks are not foreclosing as aggressively on multifamily properties for various reasons. And that's a very fascinating topic. But basically, we have all this extra time. We have all this leniency. So sellers, by and large, are not being forced to sell. The key to life is time and money. And a lot of owners right now need those things badly. And a lot of them have it, so they don't have to sell. So you're seeing very few instances of forced sellers where the seller has to meet the market. Whatever the buyers are willing to pay, that's what the seller will sell for. You're not seeing that happen very often. And that's why this whole distress opportunity hasn't really come to fruition. Back in 2022, everyone started to see the writing on the wall. Interest rates went up at the fastest rate in history. Everyone started to see, oh wow, we have actually been living in this bubble. And so everyone started to say, well, in 2023, we're going to see distress. We're going to see prices crash. We're going to see fire sales. We're going to be able to buy deals for cheap. None of that happened. It just didn't. And part of the reason is the amount of liquidity in the space. And so this is just an example of where fundamentals are disconnected to price, and therefore you can't. You can knock yourself out and go overpay, but you can't really buy a deal in a market that's experiencing this level of oversupply. It just halts construction, or it halts transaction activity. Dallas is another one. Dallas is by many considered the best market in the country. It's the most liquid market in the country. It actually has more stuff happening than New York City, which is incredible to say. And when I mean stuff, I just mean transaction volume. It's more liquid. More millions of dollars are traded hands in Dallas. If you want to sell a deal that you have in Dallas, you put your hand up, it's sold in a day. So that's a very healthy market. It's very robust. But even Dallas has a bit of an imbalance. The job growth is better at 1.9%, but the construction is 3.7%. So we're still above the national average for construction supply, and we're right about at the average for the country in terms of, or we're a little above average for job growth. So as we're going through the markets, no market's perfect, and I also am not, just as I'm not a market timer and I'm not preaching, hey, now's the time, I'm also not gonna say this market is the one, right? Because markets are always changing, and also, while it's fun to look at these numbers and analyze markets, we all know that the best investment is in your backyard. It's the one you know best. So I'm not Neil Bawa up here doing the market shootout and saying, boom, this market, that market, like let's invest in this market this year and this market that year. I'm a big believer in invest what you know, invest for the long term, and plant your flag and make it home. So it's just interesting to look at these, but I'm not saying swipe right, swipe left on these markets. But with that being said, one of our favorite markets is Houston. And Houston has a wonderful, much more positive picture with 2% job growth and 2% construction growth. That's very constructive, no pun intended, and it's very healthy. And it's one of the reasons why we've been very focused on Houston over, for example, Dallas, even though we consider Texas our home and we invest all across the state. We're having much bigger trouble in Dallas than Houston. And when you look at the numbers, you zoom out, you say, oh, well, that's why. This is very simple, right? Sellers want too much money here. I can't justify the price with the fundamentals, right? My cap rate actually goes down in my first year of ownership, not up. Meanwhile, here, my cap rate actually has a chance of going up, meaning my rents could go up in my first year of ownership. Okay, Phoenix is just another one. It's been a high flyer, and unfortunately, it was the most overbuilt market in the entire country. And just to put the numbers behind it, to prove it, the job growth is actually not that great at 1.4%, and the construction growth is 6.8%. So there's a big pipeline there, and that is just a classic situation of oversupply. And this is actually a market that we are very interested in getting into. We want to invest here, but we're going to have to monitor this for probably another year before we feel like there's enough activity that we can actually make the entry point. Okay, I think you guys are all too savvy for me to talk to you about cap rate and cash on cash, so I'll skip this slide as well. And we'll quickly touch on the sponsor first, because if you are considering or have invested with a GP or a sponsor in the past, by now you have learned that it's all about the jockey, not the horse, which is what everybody says, and it's a cliche, but it's very true. We talked about the macro, we talked about the micro, we talked about the data. It comes down to the people, and I'm not going to make this a commercial about myself, but when it comes to the people, you want to understand the track record, the transparency, alignment of interest, all that stuff, all the boring stuff, because when you see a shiny deal, you want to jump in and say yes, but you need to take a step back and slow down and really think about, is the sponsor's track record relevant to the deal at hand, right? Is this a rinse and repeat, or is this a new venture? Not saying new ventures are impossible, but those are different risk profiles. And so on and so forth. There's a long list of questions that you want to look through when going through the sponsor first paradigm. Next, which I'd say is maybe the second most important thing, is the debt, because I don't want to say no, but very rarely does debt make a bad deal good. But plenty of times, bad debt will make a good deal bad. So the amount of leverage that the industry is accustomed to taking is, typically speaking, too high. So you want to get more familiar with the sponsor and what their preferences for debt is and how they're justifying it, and understand certain metrics like DSCR, LTV, and understand true cash flow. And from the perspective of debt service, how much is the interest? Does the loan amortize? How much true cash flow does the property have? And then, of course, we all know these things by now, but fixed versus floating rates, this is always a hot topic. I don't want to say floating rates are evil, but you obviously want to understand these dynamics of a deal before you jump in if the sponsor first checks out. Okay, so now we're going to talk about expense optimization through hands-on management. So I feel like me a few years ago, if I saw this, I would tune out and say this is super boring, but I've really become an operator at heart over the last couple of years, and so this stuff is what we spend our time, most of our day thinking about, is just how do we manage our properties better. And one of the best things to focus on are renewals. And so renewals are when a tenant basically gives you such a big vote of confidence that instead of moving out, they decide to renew their lease with you. And it almost doesn't matter if they renew the lease at the same rent, at a higher rent, or even a lower rent. Any renewal is a win, and it's generally very accretive to the property. People typically say, we don't make our money on our new leases, we make our money on our renewals. And the reason for that is because turnover costs are pernicious, and there are many. So And turnover costs basically mean if the tenant decides to not renew their lease and they move out, now you have to incur all these costs. And so that would be vacancy, right? There's going to be a certain amount of days, weeks, even months that the unit could be vacant when it turns over. You also have make-ready expenses. Make-ready expenses are flooring, paint, anything that is necessary to get the unit prepared for a new resident to move in. You also have marketing and leasing costs. So you might be paying a commission to the leasing agent to sell and close on that new tenant. And you might be spending money on Google ads or apartments.com and Facebook Marketplace, all these things to market to get that new resident, which you could have perhaps avoided if you just secured the renewal. And then finally, this is something that I didn't really think about, but one of my asset managers was almost like pleading to me the other day. He was just telling me how important renewals are. And he said, you know, when we don't get the renewal, we have to bring somebody new in, and I don't know who that person is. I don't know if they're a good tenant. I don't know if they're gonna pay. And so that made him very anxious, and because he's an anxious person. But nevertheless, he's right. It's true. You take a delinquency risk when you bring in a new resident who you don't know what their payment history is, right? We obviously do the credit screening, the background check, the income verification, but there's always a risk, especially at a time like this where concessions are at a cyclical high. I'd mentioned earlier, because of the amount of competition from new apartments, there's concessions, which just means discounts. And it doesn't matter if you're a new property, older property, all properties, generally speaking, especially if they're in oversupplied markets, are offering concessions. So the reason why I bring that up is because a lot of concessions are structured as upfront and move-in incentives. And that is scary because it attracts sometimes not the most qualified people because they want to just bounce around and move in just to take advantage of the first month free, just to take advantage of the no admin fee and no application fee and this and that, and oh, we'll give you a gift card. Very scary. So that's why in a time like this, you want to even have your tenant screening, you want to have your renewals up even more. You know, when rents are going up, like they were back in 2021, that's when you might even consider the value of what we call a trade out over a renewal. You might say, you know what, I don't actually mind if this resident moves out because the new lease is so much more valuable because I'm going to mark to market and rents are going up. You know, it was amazing in those days. Rents were going up 15% per year, 20%. So you have a move out and you might be able to just not even touch the unit and raise the rent $100. So when that's happening, you might consider, okay, you know what, I might be willing to actually have the trade out. But even still, if you start tallying up all these costs, 1, 2, 3, 4, depending on where your property is located and different factors, the quality of the property, the size of the unit, you could be looking at $2,000, $5,000, or even more if you're in a very high cost of living area. So if you just do the math, you say, well, if the turn is going to cost me $3,000, what's it worth to me on a monthly basis to just keep that tenant in place? Would it be worth it for us to offer, what we call a shampoo to the resident? And when I first heard this, I was like, shampoo? Like, we're going to give them free shampoo? Like, we're going to wash their hair or something? I was so confused, and then I realized, oh, we're going to shampoo their carpet in the unit. And that costs us, I don't know, $100 maybe if we outsource it. But that could be the difference maker between the resident moving out or renewing their lease. So the tricky game is if you're willing to offer concessions and incentives for move-ins, why aren't you willing to offer it for renewals? Why don't you treat your existing residents better than people off the street? So that's where we like to get creative. We like to offer the shampoo. We like to offer perhaps a new appliance or something if there's been something bothering them with the unit, or even a concession. We say, you know what, hey, we'll just give you $50 off your rent per month or something like that. Or we'll install a real win. The real best way to go is when you can offer an enhancement to the unit, which essentially drives property value while still securing the renewal. For example, like a shampoo, not really, right? Because it doesn't create permanent value. It's just a shampoo for that year, then they're going to trash the carpet again. But installing a washer and dryer into the unit, that's some real value, right? Because if they leave, you still have that washer and dryer. So you have that capitalized value. It actually increased the value of the property. So just some things to think about when you talk about renewal rates, turnover costs. And another thing I like to think about in terms of renewals is I like to think about not just the resident renewal rate, I like to think about the employee renewal rate. All of our properties are generally 200, 300 units. So these are big properties and they're living, breathing businesses. And they don't survive, they don't thrive without the on-site staff. And so each property will typically have a community manager, a leasing agent, and a maintenance team. So the back of napkin is for every 100 units, you might have 2.5 employees. So 200 unit property could be 4 or 5 employees. And what I like to look at is the renewal rate, if you will, of the employees. And because that is a precursor or a leading indicator for the renewal rate of the residents. If the property has turnover in maintenance staff, or the office staff, the residents don't like that, they don't feel as comfortable, this is their home, this is their community. So it really starts all the way at the top when you think about designing the best environment for better employee renewal, resident renewal, and then of course, this all at the end of the day leads to cash flow, which is what we want. And this might be different for different strategies because it's very popular, or at least historically, it's been very popular in the multifamily space to do value add. You almost couldn't say the word multifamily without the words value add in front of it, right? You'd say, oh, you're multifamily? Oh, value add multifamily. And then you might as well throw on another party trick in front of that and say off market, value add multifamily. But the reality is with value add, it works best when the market is going up. And a lot of people, when the market was going up, conflated their value add efforts to just the market going up. And the reality is when you do quote unquote value add, what you might be doing is you might be kicking out good tenants, you might be throwing away good working appliances just so you can replace them with stainless steel, and you might be changing the paint scheme when it wasn't all that bad. We're going under contract on a new property, and I don't know why, but the seller has a dark granite countertop in all the units and a black subway tile backsplash in the kitchen. And I don't think it's very attractive, but we're not going to touch it. The finishes are nice. We're not going to waste money because it's 97% occupied. This is not a value add deal. And people look at me like I'm crazy when we say that sometimes because they're so accustomed to the value add. But the reality is value add does not generate cash flow. This generates cash flow when you save a buck and you can avoid these turnover costs, because although we consider it capital expenditures or CapEx when we renovate a unit and we spend $10,000, $15,000 on renovations, yes, technically that doesn't affect our NOI, but it affects cash flow. And we are more, I would say, medium-term holders, longer-term holders. We want to be generating monthly cash flow and not too concerned about renovating every single nook and cranny of the property that can be renovated and squeezing every dollar of rent that can be squeezed out of every unit. And that might sound altruistic, which we're not, and we're not a charity. That might sound like we're not doing a good job, which we are. The reason for that is because, I'll tell you this, the biggest reason for that is because when the market is hot and property values are going up, we all know this because we've seen it, we've done it, buyers will pay you on the premise of the potential for value add. They'll pay you for the work that you didn't do, right? It's called leaving meat on the bone for the next guy. So you're not missing out on the value of the property if you don't do the renovation, if you don't repaint and squeeze every dollar, because a buyer will come around and pay you a compressed cap rate. They'll pay you a below market cap rate. Basically, that is a premium to what your true income is at the property because they see a bigger vision, a next step for the property. And bless them, I'm not saying they're wrong, but that's where you can unlock the great returns. You're not missing out on the value add returns, even if you have all along the way been focusing on cash flow and the right opportunity. What I don't like and what I don't like to see is in markets like right now, and every market's different. You know, California has been experiencing a different cycle, and us in Texas different. But in Texas, frankly, rents have been flattened down, depending on where you are, for the last 3 years. And in that sort of environment, I think it is against our best interest to renovate and do value add in that sort of environment. You're swimming against the tide, and you're possibly putting good money after bad. So that's my spiel there. Okay, so some other things that we do on the expense optimization side in terms of expenses. Payroll is a big one. And I say this with some hesitation because, in my opinion, payroll is actually the single worst part of the P&L or your budget to save on. And I see it time and time again. Sponsors look at a deal and go, oh yeah, we're gonna buy this deal, we're gonna slash payroll, and we're gonna do this and do that. And it looks good on the spreadsheet, but you gotta listen to what they're actually saying. They're saying, this property is currently operating with 5 people. We're gonna cut it down to 3, and we're gonna pay them less, and those people are gonna not quit, they're gonna keep up their good morale, and they're gonna keep up the good service, and the tenants are gonna be happy, and you're gonna raise rents. It's crazy. So, like I said, the most important people of any investment, it's not me, it's not the underwriter, it's not the lender, it's these people, it's the on-site team, and specifically it's the community manager. And the key is payroll is not the place to necessarily save money, but it's the place to invest money, because the right people on your staff at the property can save the property tens of thousands of dollars by doing work in-house and by being actually aligned with you as a partner. And so it's simple stuff. Like I said, real estate is simple, it's just hard. But we bring our teams in, we bring our community manager into our annual budgeting process. They get a full view of what's going on, and they're essentially the manager of a multi-million-dollar business. And so for them to understand the budget and to understand that, hey, we repair instead of replace, and what that means for the budget, and obviously what that means for their pocket too, right? We need to have aligned interests with our on-site team, with the sponsor, and with the investors. That leads to massive expense savings that get missed when all you're thinking about is how to maximize the value of the property and how to value add the deal to, a 15% IRR. And then a couple other more, straightforward points. Admin, this is, nothing mind-blowing here, but just being on top of your vendors like landscaping, like pest control, and understanding the true needs of the property. Many times you take over an asset and you see, well, do they really need that $500 a month coffee machine contract in the office? Who's really drinking that, and can't we just buy that on Amazon for a lot less? So you kind of have to either yourself be on site, or you have to rely on your on-site people to have that in mind and to think through your eyes and to really be thinking like an owner. And so that's what we preach when we get on our town halls with our entire 200-person company with all the on-site teams. We preach, we want you to think like an owner, we want you to act like an owner and be empowered like one too. And that's what leads to the savings, like, hey, this software is unnecessary. This vendor is overcharging us, and we could do this contract in-house. And see when they get excited, when they find those opportunities as well. And then all that is the same exact story with CapEx. CapEx is essentially capital expenditures. These are your big expenses. These are your renovations. These are your roof replacements and things like that. So a lot of people ask about our vertical integrated management company. When did we start the management company? When did we bring operations in-house? And it's a big step for a lot of sponsors. I'm sure a lot of you in the room are thinking about it, or at least have thought about it once upon a time. And it's a noble thing to do. Property management is a horrible business, but someone's got to do it, and someone's got to do it for you, so it might as well be you, right? No one will care more than you. But the thing that's not talked about as much is construction. And in-house construction. A lot of people, I find it interesting, bring property management in-house, but they don't bring construction in-house. And it really should be the opposite. And actually one of the smartest people I know in the multifamily space, he actually did just that. He brought his construction in-house way before he brought management in-house, because he was like, that doesn't make me any money. The property management, I make 3% on revenue. It's nothing. It breaks even until you become massive. Construction, on the other hand, massive margins, massive. For example, we did a roof replacement project at one of our properties that was hit by a hurricane, and we got bids from $700,000 to $1.2 million, and we did that project in-house with our in-house roofing construction team. We did it for $350K. So that is real margin. That's not 3%, that's not 10%, that's not a little bit here and there. That's big. And that's something that our investors get to benefit from and obviously participate in. And it's great for us because we get to employ more people, we have more scale. And so we get to have a roaming construction team that can go to any property, any problem, rather than being reliant upon solely on the on-site teams, because they're busy just running tickets, doing make-readies, and handling the day-to-day. So being empowered with the in-house construction, it gives us the nimbleness. It also gives us, I would say, in a way, the risk tolerance to go into deals that other people may shy away from. For example, the deal we closed in October, it's a beautiful property, and it was built in 2003, and the roofs are original. And walking at the property, there's shingles all over the ground. All right, these roofs are very tired. They need to be replaced. And so I don't know this for a fact, but I know that we bid against a lot of competing buyers, and I'm sure that in their model, they had put in a bigger number than us for the roofs, right? Which led to us being able to be more competitive in our bidding, so in order for us to ultimately secure the property, right? It's a shame to lose out on a great deal, especially when you're talking about a few $100,000 here and there on a $40 million property. So that being the difference maker to empower us to say, nope, we're going to wade into complexity, we're not going to fear, and we're going to create this amazing investment opportunity that's going to serve us for the next 5 to 10 years, all because of the fact that we could save a couple bucks on the roofs, right? That's a competitive advantage. Okay, that's all I have for you. Thank you very much. Mike, do we want to do Q&A, or how do you want to run it?
Absolutely, yeah. I'm sure there's a lot of questions, so please put up your hand or ask a question for sure.
Two things. On 1031, we talked about step-up basis and how you what's the next steps, because you can only 1031 until you die. And then also if you talk about how on one of the properties you actually went to the site, lived there, what you learned.
Yeah, well, there's a couple good questions. I'm not, in terms of step-up basis and estate planning, I'm 28 years old, so dying is hopefully a very long time away from me. But with that being said, you're absolutely right. The 1031 exchange essentially allows you to defer, and you don't have to recognize the capital gains tax. And then even better, the government is so nice to us that when we die, we get a step up in basis. So if you bought the property 30 years ago, or the chain of properties that you 1031 for $100 30 years ago, and then now it's $10,000. When you die, it becomes worth $10,000 to your heirs. And so if they were to have sold it right then and there, they don't owe any tax. So the tax effectively disappears. That's why you hear all the conspiracy theories about the rich, right? They buy, they borrow, they die, no tax. But there's actually a catch, because that only works for your estate. And your estate is, what, 30 million, right? Somebody, who knows this number? It's like 29.8, right?
They just bumped it up.
They're going to keep bumping it up, but it's, for all of us mega millionaires in here, it's not enough. So you only get to use that in your estate. So in order to work around that, you need the trust. So I'm not qualified to talk more about that, but obviously, if you're rich enough, you've got smart enough people in your corner to maximize the assets that you put in your estate versus that you put into your trust, and then keep 1031 exchanging all the way, and you don't stop. And then to answer your second question, back in 2024, I moved to one of our properties in Houston, and I lived on site. This is a very good experience, and this is kind of where I gained a lot of those expense optimization kind of ideas, and we're building our operational thesis of how we want to be as a property management company. And just by living on site, you know, I'm a tenant, so the things that bother the tenants, they bothered me. And I noticed the things that weren't happening that I wanted to happen, and the manager that's telling you one thing, but really something else is going on, right? So there's no, like I said earlier, data is great and market knowledge is great, but your backyard is better. And so that was an experience where I had to make Houston my backyard, and fortunately I learned a lot, and I'm now back in New York and on to the next, you know, learning venture.
Awesome. All right. Who else got questions?
You mentioned Dallas. There's some other groups out there talking about Dallas and how the income or the incoming population is far outstripping the deliverables. But there's some disagreements there. So I certainly have people on the ground that are seeing the pain of over-delivered market. And where do you see the longer term for Dallas? Have you looked at that at all?
Well, you and your insiders there are absolutely right. It is an oversupplied market. People were saying, oh, a year ago they were saying 2025 is the year. Rent growth is around the corner. Supply is going to come down. Concessions are going to burn off. And you know, really, the story of 2025, not just in Dallas, but most of these markets, was that didn't happen. Everyone was excited about turning the corner heading into 2025, thinking all those things would happen, and they just didn't. And so now, same thing. Everyone's thinking, oh, well, 2026 is around the corner, and we're going to finally see the turnaround. And I think the data is starting to show that that will happen, right? I mean, we're seeing the supply-demand move in the other direction to be much more favorable, even in an oversupplied market like Dallas. I think the long-term picture in Dallas is very favorable. I think that the trick is there will never be the supply moats in Dallas like there are on the coasts, like San Francisco, like Los Angeles, San Diego, New York, Boston. These are true supply-constrained markets where you have just really, really good fundamentals. But there are pockets within markets like Dallas where you can count on less available land. It's not economic to develop. There might be political constraints even in markets like Texas. So I think that there are spots to pick on in a market like Dallas, in Houston, and across the Sun Belt that you will 100% see a very favorable supply-demand imbalance in the landlord's favor over the next 10, 20 years.
And just to emphasize your point, real estate's hyper-local. So there's going to be pockets of oversupply and undersupply, and in that undersupply could be the opportunity still in that same market. It's always hard to look at this as a macro, you know, formulate an opinion on a whole market when you and I both know that like East Palo Alto and Stanford are very close to each other, but very different experience.
100%. We are acquiring this new property that we are putting under contract is in the Copperfield submarket of Houston. Not that any of you guys would necessarily know what that is, but it actually ranks #1 for absorption. And the reason for that is just very simple. There is no new supply, no construction in a 3-mile radius of the property. And that speaks volumes. Like I said, the headline, the #1 thing that I want to know about an investment today is the supply picture. Any other questions? We got oh, here, go for it.
How did you raise the money you raised?
Great question. So,
You see his hair?
it's the hair. Yeah, I mean, it's another, that's another great topic that I love to talk about, but it's a very tough and lonely road starting back at 20 years old, right? I was fortunate to grow up in Silicon Valley, right around the corner. A lot of successful people, a lot of high net worth people, but nevertheless, when you start out, no matter whether you start out young or old, you don't have the reputation, the contacts, the experience. So I didn't let youth be a crutch. In a way, I almost let it propel me. And it's funny to say, but the propulsion was from ignorance. When I got started, I underestimated how hard it would be to raise money. I thought, well, I'm going to find a good deal. I'm going to present it. I'm a numbers guy too. So in my head, I thought, well, if the numbers check out, I should get the investor. Right? I didn't know the principles and the realities that people invest with people and that they want to trust you and so on and so forth. But with the absence of that knowledge, I just jumped in head first. And so I became obsessed with everything that I was up to, and I became single-minded in accomplishing my goals. And so it sounds totally unhelpful and unsexy, but I spoke to every single person I knew, and I asked for an introduction from every single person, and I drove the network for every day of my life for a few years. Was just phone calls, meetings. This was before Zoom, but yeah, phone call, meetings, in person, everything. Being super humble, because what did I have to be cocky about anyway? And so after getting beaten down and doing a few capital raises brute force, which it works. If someone here is asking me, how do I raise money for a deal I'm trying to close in 30 days, right? My advice would be very different than if someone said, I want to build a machine, right? And that's what I realized. What I realized after brute forcing it is I need a machine. And so that's when I set out to get out of my comfort zone, to get out of my shell, get off my high horse, and start making content, like writing articles, writing newsletters. I eventually wrote a book. Doing podcasts, doing speaking events and things like that. And so the challenge with that is just sticking with it, because you're not going to raise any money from that. It's not going to pay off. It's going to be a total waste of time until eventually it becomes not a waste of time. So fortunately, I stuck with it. And then now we have 2 books that have sold over 30,000 copies and brings us investors every single month. And we have raised over $250 million, all through retail investors, average investment size of about $150,000.
Very good, congratulations.
Thank you.
I have to interrupt Rob and just say that's one of the most compelling things I've heard from you all night tonight. And everything else was great, but this genuine story of yours that you personally shared, of your personal journey, I really appreciate and admire.
I appreciate that. I struggle talking about myself because I'm a numbers guy, and I'm bashful, and I just want to stick to the data and what I know, right? But the reality is that's another thing that I missed out, because such a good point. When I first started, I hid behind, I didn't want to show my face. I didn't want to go on a Zoom call. I'm too young. I look young. I don't want to talk about my personal story because I'm shy about my personal story. I don't want to be found out about whatever, I might not be, right? So if I just talk about the numbers, or if I talk about the deal, like, nobody can find fault in me. But as soon as I started being personal, which I still struggle with to this day, to your point, that's when the results came, right? That's absolutely right.
Yeah. Wow.
All right, this is a numbers question. Discomfort.
We're back.
So, according to Marcus Millichap, Dallas market, which is kind of what you have in mind. I want to go back to the numbers that you have here. The vacancy for a Class A is 7.1, so it's high. It kind of matches with what you would expect. But for Class B, it's 5.9, and then for Class C, it's 5.4. So while they are in balance between job growth and development, do you think it's really more going to affect Class A rather than Class B and C?
So I would want to see the data on that as a trend. So I'd want to see, okay, well, what's the historical? Because that's typically the case on a historical basis. So I'd want to see, how do those things, how did they spike? Did they move in tandem, or did the Class A spike more than the B, right? And not to say that you have the answer for that, but...
I have.
Oh, you do? Okay, go ahead.
Actually, all 3 of them trended down 120 bits.
So they're moving in lockstep.
Yeah.
Yeah. So that's a good sign. There's other markets that I've seen where different classes actually spiked more, so they didn't move in lockstep. But what I would say is, generally speaking, you will see the tighter occupancies in the lower class properties. I think the reason for that, though, is partly the data is manipulated sometimes by lease-ups, right? Because a new property, it's Class A, just got built, and now it's leasing up. So it's 30% occupied, 50, 60. So sometimes the data doesn't fully take out the properties that aren't fully stabilized. And then the other thing too is older properties sometimes are smaller, and smaller properties tend to have higher occupancies. So that can also, in a way, skew the data. And so I was actually talking with Mike before this tonight. I think it's a bit of a myth that people can just totally ignore, and they just write off the idea that, they tell themselves, well, in a recession, the A's move down to the B's and the B's move down to the C's. And so if you're down at the C's, you're actually going to do the best. And the reality is, in my opinion, in our experience, the C-class renter is the most income insecure. They have no savings. They are, if they lose their job, that's it, they're toast. They're going to have to move out. They're going to skip. They're going to be evicted. It's not fun at that Class C level. Meanwhile, the Class A renter, they have more options. They have more savings. They have more income relative to their rent. So they might not be more sticky in the sense that they might be more inclined to move if there's a shiny new building, but they can afford the rent. And the reality is, at the lower levels, what you see, like I said, people lose their job, that's it, they get evicted. They move back home with their family. They move in with roommates. They do whatever they need to survive. It's very humbling being in the workforce housing space because you see the reality of the average American, and it's tough. So me personally, if I want to have the best experience and the best performance, when I say experience, I mean the best performance of our property, I want to be in the Class A properties, which in our portfolio have 25 basis points of delinquency versus our lower end properties have 2% or even sometimes higher in delinquency. So that I think is and the other thing too is concessions. People think that concessions only impact new properties, but concessions trickle down all the way. It's just logical, because if the brand new property with the most beautiful swimming pool and the golf simulator and this and this and this, they're going to offer rent discounts. They're going to try to suck up all the renters. And so now people are going to jump to that new shiny one, and then the people that were in that older building, slightly just new but slightly older, now there's vacancy there. So that owner is going to turn on their concessions, and they're going to try to suck up the people from down below. And what we actually saw in this 2022, 23, 24 era is people actually moving up in quality, not down, which is a good thing. It's a sign of a healthy renter in the economy. That's great, but it contradicts the thesis that the most stable housing is Class C.
When you're evaluating properties at the highest level and you're trying to figure out which ones do I spend more time underwriting and which ones do I just pass on, what's your process and the criteria?
I love this question because I have a lot of thoughts about it. So the question is about basically qualifying deals. Do I spend more time on this one or do I pass on it? And my philosophy is that you want to spend time on the qualitative features of a deal before diving into the quantitative, because qualitative is instant and the quantitative takes a lot of time. You need to look through the rent roll, the financials, you need to really dive deep into the numbers. And why do that if the qualitative doesn't make sense? If the schools are not good in the area, if the units are just not the right fit. For example, we are, generally speaking, a suburban buyer. We buy in the suburbs. We want to rent to families. I will not buy a property that is majority one bedrooms. I just won't. Similarly, I don't want to own a property that has smaller units than the average in the area. So even if they are 2 bedrooms and 3 bedrooms, I want to be competitive with the families there. So I want to have the bigger units in the submarket. So those are just some qualitative things that I look at. Crime would be another qualitative thing, right? You can't really put a number on it and you don't necessarily plug it into your underwriting, but it's something super important. So you want to look at all those things that are more qualitative, even things like, or especially things like median household income, the supply story, before spending time on the quantitative and really diving deep.
Great question.
I think we have maybe one more.
You got one more?
Yeah.
What belief changed for you? For example, you made a really great point about emphasizing renewals instead of typical value add. So I'm curious, like at what point or at what AUM level, it sounds like you had a realization. Can you
On that specific realization, would you say?
No, just an example, or that if that's a belief that changed for you from when you started till now.
Yeah. So there's a ton of realizations, right? We're always learning, and that's something beautiful about the investment business, the management business, is we're thrown new challenges at us every day, and then we also are all together experiencing the ride of the market cycle, right? And you learn different things at the bottom of the cycle, you learn different things at the top of the cycle. And sometimes, whether you even care or want to learn that lesson, you get taught it, right? You're forced to get taught it. Like, for example, people that used too much debt in 2021 and 2022, whether they liked it or not, right? Maybe they weren't looking for that lesson. They got forced to learn that lesson, right? And the key about these lessons is to not forget them when the cycle flips, right? Because a lot of people may learn the lesson of whichever one it might be, but by the time the cycle comes to repeating itself, they've already forgotten. So what I tell myself and I think about in moments like today, which today I would consider ourselves closer to the bottom of the cycle than the top, I think about, let's call them bottom of the cycle thoughts, and I think about, well, let's not forget about this when the cycle is at the top again, right? When everyone is talking about multifamily investing and there's 500 people in this room because everyone wants to do it and everyone thinks that 25 IRRs grow on trees, you want to remember your bottom of cycle thoughts and not get caught up in it. And so I would say that's a realization that I'm fortunate enough to be in the position today and learn from. They say you go through your first cycle and you hope to survive, and then you hope to learn from it so that way when the next cycle comes around, you can take advantage of it. So that's what we should all be thinking about right now is what do we learn in whatever we're up to right now, and how do we take advantage of the next cycle that comes around? Because right now it feels like a forever away and that it might never come again, but it will come again. So that I think is really important. All right, thanks everybody.
Thank you, Rob. Thank you, Rob.
Thank you.
I don't know if you posted this, but he has 2 books, right? So you talked about that. One of the books